Well, when it comes to concerns about the rising level of corporate debt, much of those fears have centered around high-yield bonds. But now one investor says top-tier credit may not be as safe as you think. Monica Erickson is DoubleLine Capital's head of investment-grade credit, joins us now. Nice to see you.
Thank you.
Good headline. Why not as safe?
Well, I think one of the risks that is not being talked about is the duration in the investment-grade market. So historically, and maybe back up a little bit, the investment-grade market is a massive market. There's over $7 trillion of debt outstanding, which makes up about 25% of the investable universe. So I think it's important for investors to be focusing on the risks in that market, in particular since it's done so well.
I mean, spreads have obviously remained really tight.
Yes.
People say, okay, that's a sign that we don't need to worry about anything.
Right.
And I go back to, calls over the last few years about, high yield's going to blow up, and we haven't seen that. So
right.
What kind of time frame are you talking about that we could see trouble?
Well, I think the trouble, or maybe the thing that I'd like to alert investors to is to take a look at what the duration is in the market. So it's the interest rate sensitivity that the asset class has to a change in interest rates or a change in spread. And currently, it's at the longest it's been in history. So not only is the setup difficult because valuations are stretched, you also have an asset class that has an extremely long duration, so has a lot of volatility around interest rates. And I think that is the part that investors are not focusing on.
Do you think that investors are just simply too complacent across the board when it comes to levels of corporate debt?
That's a different question, I think. I think the duration aspect is very specific to the volatility that could be introduced into the market because of changes in interest rates. The idea that the market has grown as much and that corporate issuance has been heavy, I think that's a different discussion, but it's something that we are very mindful of as well.
Joe?
If the Fed was to pause the repo operation, the $60 billion per month that they're purchasing right now, would that accelerate your concerns for duration?
I think the concern with duration is that if interest rates go up, the price is going to go down, right? So historically, the investment grade asset class has had about a 6-year duration. So a 1% move in interest rates either way is going to move the asset class by about 6%. Right now, it's 7.6 years. So a 1% move is going to move the asset price by 7.6%. I mean, we've had rates fluctuate in the 10-year from, call it, we're about 188 right now. I think the high was about 320.
Yep.
So if you get a 1% move in the 10-year, you could see this asset class drop in price by about 7.6%. And I think that is what's being missed in the discussion. We talk a lot about credit risk, yep, about issuance, about triple Bs. There are definitely a lot of other risks in the market, but this duration aspect is one part that is, I think, not getting enough attention.
So, Monica, I'm curious what you think about this. It appears that in the last few years, because interest rates have been so low, that companies like Apple, who don't really need to borrow $7 billion.
Yes.
So has that possibly made investors much more confident about buying these bonds, perhaps paying up for them, and not worrying as much about the quality underneath because they think these companies don't even need the money to begin with, but they're giving me some yield. It's like buying a treasury.
Right. I think there is definitely there's an aspect to that where there have been issuers that have come into the market that clearly do not need the cash, and I think Apple's probably the best example of that. I think that I'm not sure that investors are complacent about that. I think there has been a lot of discussion around concerns about credit quality, just the increase in the triple Bs, increase in leverage in the space. So I wouldn't say that investors are complacent. But what I would say is that corporate entities have taken advantage of low rates and come to market borrowed, and in addition borrowed longer because rates are so low that they've extended out their maturities and once again pushing the duration of the asset class a little bit further out.
Monica, we appreciate you being here today on what is a busy day in the market.
Yes.
That is DoubleLine's Monica Erickson joining us.